But now going back to the main point, the corporation wants to add value, increase shareholder value. So how do you do that? You have to choose projects that would increase value. And that is the metrics that we use is NPV. So if the projects have a positive NPV, you would take as many as you can. What will be your constraints? Will be time, resources. You can't take all of the opportunities, but the idea is you want to take as many as you possibly can. So by not taking some projects, you're actually leaving money on the table, okay? So a corporation really want to find the most add value projects, and he wants to undertake those projects. And you as the financial manager, you want to make sure you're able to do that. Also, through the financial statement analysis, you'll be able to have a thorough analysis and understanding about a business. Okay, now let's just say that this business is growing really rapidly and really well. We have so many examples in the United States about businesses like that, such as Uber, you have Amazon, you have Facebook, you have Apple, and so many other businesses, right? And so it gets to a point that you're like doing really well, but in order for you to take the next step, you need more cash, you need more investors, you need more money. And then that's when that company has to make a decision. How do I finance my growth? Because I'm growing too rapidly. And if I keep growing at this rate, I might have a cash flow issue, or I might be in a position of risk. So normally what a business would do is they can go take a loan at the bank, and which will finance their growth. But once you get a loan from the bank, as you learn doing your financial statement analysis, what's the big problem with that? You have a fixed expense every month, and that's a cash transaction. So your capital structure, the bucket that you do that thorough analysis, it will make your company more and more, your company will be riskier and riskier. We'll have more and more financial leverage, which is a good thing, but it can be a good thing, but it has an optimal point, where after that optimal point, that starts to actually be detrimental to your progress and to your returns, as it increases your risk substantially. It will be a common sense for all of us to understand this. And you can imagine if you buy a home, and you buy a second home, you buy a car, a second car, a TV, and you have a lot of financing, and it gets to a point that your recurring payments will stay the same. And what about if something happens to your revenue? So that's called capital structure risk, correct? So companies, then they have another option. They said, well, instead of getting the money with the bank, what about if I open my business to investors, and I'll sell small pieces of my corporations, and I have a lot of people coming and join and actually have ownership in my business, and I'll share the profits, I'll share our growth with them. So that's the famous IPO, initial public offering. That's when a company starts selling its shares. So when a company does that, it has an infusion of money, millions, billions of dollars. And absolutely, when the company issues stocks, okay, so what the company is doing is raising money in the financial markets so it can finance its growth. When it does that and invites someone to be part of that company as an owner, it has absolutely no obligation to pay anything, has no obligation to pay dividends, has no obligation to pay any debt, so the risk is very, very, very limited, because now you have a bunch of owners. You just got a bunch of cash in your balance sheet, in your statements. So that's what businesses, they do in the United States and across the world. As a matter of fact, there is a strong correlation with efficient capital markets and the development of a nation. Let's take the United States, for example. Today, the United States is the most developed nation in the world, greatest GDP, and it has the greatest financial market in the world. And the opposite is true. Countries that are not very developed is because they don't have a very well developed financial markets. And the reason is that because the financial markets will connect the surplus of cash with those that actually have good opportunities, but they are lacking capital. So the financial markets will make sure the capital goes in and out of the economy and make sure the economy is as productive as it can be. So once that company issues its stock, it gets all the bulk of the money and it can grow, and then the investors now own that stock. Once they own that stock, they became wealthier, and now they're owners of a little bit of the piece of the American capitalism, or a little bit of a piece of a given company. So let's just say, for instance, that the biggest 500 companies in the United States, they have an index called the SP 500. And let's say if you buy a little bit of, you buy an ETF out of the SP 500, which, by the way, is the best way to buy the SP 500 is through an ETF. Normally, when you use mutual funds, you pay too much fees. Not the scope of this course, but let's just say you pay an ETF, which has absolutely no fees. And let's just say I have a graph right here, and you bought that $1 in 1926. So in 2014, which is 6 years ago, you would have almost $6,000 or $5,000. So your money multiplied greatly, right? So how did your money multiply? Well, that business took many add value projects, its value went up, its equity went up, and just by the fact that you own that stock, the capital gain, the stock appreciation, the price of your stock went up. There's a second way that you can make money. It's called dividends. Now, it's up to the CEO, it's up to the board of directors or the company management to decide how much and if they'll pay out dividends. But there's quite a few companies, there's actually many companies that do pay dividends. So dividend will be a cash payout for you as an investor. Okay, so now if you take a look at this graph here, you would see that now we're talking about that business that really grew, and now it's a public corporation. And then you would have two sides of the equation. On the side of the business, he got a bunch of cash so he could finance its growth. Now, you have the other side, which is the investor, which is the hardworking American family. It's the hard work professor, student, business owner, and he wants to build his retirement. So he goes and he saves money, and he buys stocks, and he buys bonds. And then he comes the question, what should I buy? And what is the difference? So I have a graph here that shows you different investment vehicles, okay? So, what is an investment vehicle? A vehicle is something that you use to bring you from point A to point B. Is that a better vehicle a best or a worse vehicle? Definitely, but it really depends where you are and where you need to go. So all of those investments here that I'll show you, they are very good, but they're just different vehicles. So let's start here with the 30-day T-bill. So if you bought the 30-day T-bill for $1 in 1926, you would have $13 in 2014. Now, if you buy a long-term government bond, you would have $131. The SP 500, you have $5,000. Small cap, which is a smaller companies, not as large and developed as the SP 500, you would have $26,000. So you see that there's a big difference in those corporations. So where should you buy? What's the difference? So you would see here that you have different returns, and that return is directly related to the risk. So the greater the risk, the greater the return. So what we can imply, or we can say then, is that the 30-day T-bill, that's absolutely no risk. You put your money there, and in 30 days you get it back. It's almost impossible for the U.S. Government to default, and so you're going to be right there. You're going to be nice and good. Oh, and I'm sorry, let me make a quick correction here. The inflation will be $13. The 30-day T-bill will be $20. So it will actually be a $7 real return. Anyways, a very small return, but your money did did grow. I mean, you did multiply your money, right? But there's absolutely no risk. So why would a T-bill be good for who? It's someone that actually needs a lot of liquidity and they don't want to lose their money at all. They don't want any risk. And then you have the government bond that gave you a little bit more of a return, has a little bit more risk. It's absolutely risk-free. It's just you got to wait for longer years because, again, the U.S., the probability of the United States to default, it's very low. And if it does, the whole world will actually go down with it. Okay, but then you go to corporations, which you do have a lot of risk. But when you put, instead of having one business, let's say instead of just buying Apple, you buy 30 companies or more, you are well diversified. So you don't have any business specific risk, especially if you buy the S&P 500. So you're eliminating any specific risk of a company. So now you are just having the market or the systematic, the economic risk out of those companies. Okay, so so you see that you would have a risk premium. Okay, so the gap here between this green line to this, it's called the risk premium. So what is the risk premium? Is the reward that investors will require to take on more risk. And you see that there's another risk premium here between the small cap and the S&P 500 because the smaller businesses are riskier than larger businesses. So it's really about you as the investor choosing what company should I invest? How much risk do I want? Something that I wanted to discuss with you quickly is that how do you actually measure risk? Okay, so let me show you how do you measure risk. So risk is measured by volatility. Volatility is measured by the standard deviation. If you put it in a statistical term. So what that means is that on average, if you make the calculations, the volatility will be how much does that stock deviate from its median. So let's say you have an average and a small cap will actually go up and down a lot more than a large cap. And that will go in the same direction as you go to bonds and then as you go to U.S. Treasury bills, okay? So if you look here, the U.S. Treasury bill down here, it has an average return of only 3.5% from that whole period of time, from 1926 to 2015. And you have a standard deviation of 3.1. So that means it doesn't go anywhere. It's really nice and steady, right? So that you're not going to have ups and downs. What's an up and down? The price can go up and the price can go down. And what most investors do is when the price goes down, they really panic and they sell. And when the price goes up, that's actually when they want to buy because they think it's doing really well. So you have to have a lot of emotional intelligence as you become an investor as well, and be aware of the facts that I'm sharing with you here. So, so you see that the standard deviation is highly correlated with the average return. You will be rewarded for the risk that you take. So you take a look here at the small companies, their return is 16.5%, but look at the standard deviation, it's 32%, okay? So there are some techniques that you can maximize the relationship between average return and standard deviation. And there's actually ways you can measure that. But right now, I just want to make sure you have an understanding of how this works. Okay? So, we're going to use, let me take a look. Let me show you here another graph, which is the market risk for the world. So you see the United States have a 7.2% premium, and you have countries such as Italy that it will be 9.8%, and you have Denmark, which is 4.6%. And again, why is Italy have a higher return than Denmark? And it has to do with volatility. So you see that Italy will be riskier, to have more volatility, more ups and downs. The standard deviation will be higher than Denmark. So Denmark, you have more of a steady growth of its business. So with this video, I hope you got a greater understanding about what happens when a business grows. It's doing a lot of NPV projects. As you still have in mind that you got to do your financial statement analysis and cash flow analysis. And then that business has a decision that he doesn't want to take any debt, that he wants to grow and he wants to finance its growth with investors. And he gets a bunch of money, it can grow really well. And then you have the stock price, that the stock market, which gives an opportunity to all of us to be part of the prosperity of America, prosperity of the United States, and the prosperity of any given country in the world. And that's through the financial markets. And I want you to have a clear understanding about that you can make money in a stock by capital appreciation and by dividends. And risk is measured by volatility, which is how much the returns will deviate from the average, from the median. And then you have to make sure you make the right choice for you. You got to have an investor profile, okay? The risk premium, you will see that we use CAPM. I'm going to post a link later on about CAPM. And CAPM is a theory that's widely used to make that calculation of the relationship between risk and return, okay? It's all really nice stuff and really interesting and very good for you to know that as an investor, and also as you are taking a closer look at corporate financial management as a possible financial manager. So thank you very much. Let's keep in touch and have a great week. Thank you. Bye-bye.